Good morning, good afternoon. Happy October. Oh gosh, it's Q3 already. I know this particular year just passed so quickly. Can't imagine. We are in the final quarter of 2022. Jeez. Before you think the year is over. Given what we are seeing in the market side, maybe I hope, those tumultuous time, generally when you think at it, they feel that it is lingered way longer than it actually does, but not this year. Even though the market is so bad, but for me personally, looks like their year has passed very quickly. Hope this turns out to be a good quarter. Yeah, keeping my fingers crossed, but I think I'm not sure. There's still a lot of macro headwinds going along. But yeah, what does it matter? How does it matter? It's one more quarter. We survived 3. We can survive few more. So, so not a big deal. If you really ask pundits, I mean, they're still projecting more pain ahead of it. Samuel asks, what do you think about internet security? It's a very hard market. I think a few weeks ago we talked about, is it a recession proof? I mean, a lot of this internet security, not just internet overall, when we talk about the cyber security, those stocks, Palo Alto Networks, Zscalers, CrowdStrike, Sentinel-1, Fortinet, those have been less impacted as compared to others. Right? Nowadays, companies are taking the internet security more seriously. It used to be cost of doing business. Yes, Sam.
What I'm asking is because in 1998, the South China Morning Post of Hong Kong was printing that cyber warfare, stealing corporate secrets over the internet is going to become, I guess, cybersecurity is going to be big. And back then there was this guy that excuse me, I forgot his name, but he was stealing secrets, and U.S. was really triumphing that this American agent in San Diego was able to trace him. So I thought the U.S. was ahead in cybersecurity back then, but I don't know, maybe 5 years ago, it was actually behind. And they, in other words, is the U.S. still in a decent position to protect itself? Like, there was an article I was watching on Wall Street Journal this morning that the U.S. government has to be very alert about they're going to have like $88 billion of foreign investment in Silicon Valley firms. And the Wall Street Journal article brought up, are they going to steal our technology?
Yeah, so I think, it's a very timely topic around US, the strength in cybersecurity, and let's say cyber warfare as such, right? So not sure. So there was a documentary that I watched, I think maybe in last week or a week prior to that. I had read that book a few years ago, which is about something called a Stuxnet virus, right? So there is a documentary called, let me just pull that out, 0 Days. If you have time, watch this. This just blew my mind. I mean, even though I had read that book a few years ago, and it just blew my mind in terms of again, US officials will never confirm, that they were involved in this, but this was like completely sci-fi, out of this world kind of a cyber attack that was done on Iranian nuclear plants, basically to slow down their progression towards, attaining weapon grade uranium. Did that meet its objective? Different question, but it did talk, gets in details and tell us in terms of still, at what level of strength does NSA and their partners have. Now, this is a few years old. I guess maybe this happened around 2012, 13, somewhere from that time frame. And of course, the rest of the countries, especially not so friendly countries of US, have become wiser. And I guess the next warfare will start with cyber wars. We will not have folks, fighting on the ground. Already we moved from doing, land battle to mostly the warfare moved towards the air power. So whoever had more air power would, was the strongest country. I think the next frontier is whichever country is the strongest in the cyber warfare will probably, whoever has the most capabilities in cyber warfare will become the strongest one. So we are seeing more and more state actors and state-sponsored attacks across the world. It's difficult to prove, but this is becoming very sophisticated weapon, I think, in every country's arsenal. And unfortunately, we were the first one to use this cyber warfare as an arsenal under this 0 days, if you see that commentary. Yeah. So I'm still excited about the cybersecurity companies as such, but there is always a hype cycle. So let's be sure that we don't go overboard with these, right? Like we had a hype cycle on 3-day chips, we had a hype cycle on internet securities a few years ago. These cycles come and go, and then we had a big hype cycle on the semiconductor, and now SMH is down.
So you see that next comment I make is that the U.S. justifies itself that we moved away from that search and chip technology. But the thing is, we did sell it to Japan on the cheap.
Yeah. I mean, I don't know. We can probably dig deeper later on this one. I have not said it, but I was fascinated by the whole operation and what was done under Stuxnet. All right. Coming back today, we'll talk about DocuSign as a company, and of course, the other general stuff around macro side. What's been happening on the world? What is the different banks are doing on the world? And let's start with this all red picture. Right? This is S&P 500. Most of them ended up in red. The most surprising, and we will talk about it, is Apple was down 3% on Friday. And I think this was on top of them being down, I guess, 4% on some other day. I think maybe it was Thursday. It was down 4%. And I recall, opening up my Thinkorswim and seeing Apple is the biggest loser in terms of percentage among the other stocks. I'm like, when did I last see this? What has happened? But of course, I had only 30 minutes. I couldn't dig into the details of it. But that was you don't see those days often, that when Apple is the biggest loser in the index. But yeah, things happen. These are not the normal days. So mostly red. All right, let's dive into it. For today's sessions, as always, everything here is only for education. Nothing is financial advice. So please, please, please do your own due diligence. Okay. So what did I see? This is how the overall S&P did. We are down almost 3%. As goes the Apple, so goes the indices. Right. So far, even though we felt a lot of turmoil in individual security names, some of the stocks are down 50%, 60%, 70%. Overall indices were not that bad because some of the biggies, they were still holding their fort. But now we saw Apple tumbled, and I think it's more than 8% in a week. We saw Google is down. Google hit its new 52-week low, 97 or something. So when those biggies start to tumble, then we see, the overall market starts to get impacted. So if you look at, we are down 3%. And the worst performer is utilities, right? They were down almost 9%. And this is different as compared to what we saw. So last week, your overall S&P was down 5%, 4.6%. This week it's down almost 3%. So we can add, I think what I heard was maybe in September month, we are down almost 9% on overall S&P 500. September is generally considered to be the worst month anyway. So I'm looking forward for maybe October, and the rest of the months will bring some positive news, some good news. We shall see. For now, I would say September has lived up to its reputation of not good months. So that's on the S&P side. I think it was relentless across all the sectors. There was nowhere where you could go and hide if you're invested in markets. So I did see a lot of chatter among my friends. Lot more people have become aware of what is a treasury bond. How do I buy a bond? Well, what is these I bonds? How does that impact us? A lot more questions coming around treasuries, and even the good old bank CDs start to look attractive, man. I mean, I shared last week, we spent some time on, CD rates are higher than the mortgage rate. So, and I just noticed this week, it got bumped by another 0.1%. I don't recall these, haven't seen these things before. That now within a week, your bank has increased the APY on by 0.1%. So, but yeah, these are the days. And we had a little, 4 hours of kind of offsite, and we're talking to some of the colleagues, everyone, what's happening? I don't know, when you can get 4% on treasuries, which is considered to be the safest, why would pension funds or, why would someone take a risk of investing in markets where on an average you get 8 to 10%, but you have a risk of losing money, right? So, but yeah, these things don't start. It happens in the cycles. This, in my opinion, this will again, will live through this cycle, this bear market, and go back to how the business, generally the stock market behaves. Steve says utilities down. Yes, they were down. It was trading desk of utilities companies are idle. And quick summary, Bank of England. Who thought, and this is sometimes I find it hilarious, is what's happening in England. The pound had its worst day. Yeah, if you're going to Europe, you're going to UK, your dollar will go longer than how it had been in the past, right? So we saw the new government in UK, is a trust government, came in, did some tax cuts for wealthy people, gave energy subsidies, essentially doling out free money again, increasing government borrowing, whereas the rest of the central bank, other countries are trying to rein in spending, reduce borrowing. UK did a U-turn, and the impact was the gilt, which is equivalent of treasury bonds in UK, their yield just shot up. I mean, markets started to had concern around these measures from a UK government, and how they will they be able to survive. So the gilts yield shot up. That would have bankrupted some pension funds, some big institutions, would have gotten a huge margin calls if that situation wasn't controlled, and Bank of England jumped into the market and started saying, they want to buy long dated bonds. Like, they're back to quantitative easing, QE. Bank of England has started to pivot. So the moment that happened, we saw markets had a good day on, I think it was Wednesday. So Bank of England did come back and say that we'll make it a temporary purchases of long dated bonds, right? And we'll do whatever is required to restore orderly market conditions. So yeah, I don't even know. I mean, this is I think central bank has got itself into a corner. If the conditions become too tight, the market started to tumble, not the stock market, but the general economy start to tumble, and then they come back and then try to prop it up by buying bonds, government taking more borrowing. It's just crazy. And then we also saw IMF doing kind of a rebuking the plan of UK government, saying, guys, you need to have your heads on the shoulder, right? So there is a tug of war happening on the UK side, wherein government goes and announces the plans for reckless spending, and then the Bank of England jumps into and say, don't worry, we got your back, but then that will lead to higher inflation, that will lead to concerns about the rating of UK bonds. So on the other side, now Bank of England will start to increase the interest rates. So two conflicting stuff. On one side, you buy bonds. On the other side, you're going to increase the interest rate. And if I recall correctly, the plan is that Bank of England is going to increase the interest rate by 1.7%. That is 170 basis points. Can you imagine? Fed did it 75 basis points. And Bank of England is planning to increase it by 170 basis points. Yeah. Robert says, money from UK flew into the dollar. Oh, exactly. I mean, the world lost their faith on the financial stability or financial mental health of a UK government. So pound is no longer, be considered as something that can hold on in times of turbulence, which will retain its value. So yeah, money flew into dollar. I mean, we here sitting in US still crib about situations are not great here. Situations is bad. Inflation is 40-year high. Market is not very good, but we are still better than, or considered better from optics perspective. The world still thinks that US is still US treasuries are still the best asset when it risk-free asset to hold in times of turbulence. So you're right. Money flew into dollar, and dollar is still getting stronger and stronger. So, and that is now dollar becoming stronger and stronger has its own pros and cons, right? Plus and minuses depending on where you live. For Americans, if dollar is stronger, the rest of the world becomes cheaper for us. If you're going out on a vacation, suddenly your dollar goes, can buy more things than what it had been able to buy historically, but it wreaks havoc on developing countries. Most of the debt is dollar denominated, and dollar becomes stronger. There's more scramble for, it hits the other country finances a lot. So every time dollar becomes stronger, we see crisis in developing countries, right? So Sri Lanka already gone bankrupt, Pakistan facing tough times. Yeah. So, and dollar being a reserve currency, there is, countries still want to hold dollars. Yeah. All right, so how did that impact our market? S&P index broke below its mid-June low. So mid-June was 362. Where were we in mid-June? Let's get on to year one. There we were, mid-June. So every time the talks has been, is that a support level? Right. Most of look at the technicals, this support, June support, has been talked about a lot, saying, will this hold this time? Probably not. And the Bank of America analyst, which spooked the market last week, was saying if it 360, you can start to nibble. 330, take a bite, and 300, again. So if you have faith on that Bank of America analyst, this is the time to nibble. We are below 360, hitting a new 52-week low at 357. So S&P not doing that great. So biggest move came, we had a big up move on Wednesday after Bank of England. We thought that Fed might also pivot, but Bank of England has pivoted. Maybe we'll see Fed also loosening its hawkish stance, but didn't happen. And 10-year breached 4% for the first time. On the US side, inflation numbers came in worse than what was anticipated. Quarterly, we saw PCE, which is Personal Consumption Expenditure Index. It rose 4.7%. Expectations was 4.4%. Monthly was up 4.9%. Expectations, right, which was hotter than what was in July. So inflation is still higher. Now, only one thing is, if Fed is taking action based on this is an old data. This is looking into rear view mirror and driving the car. And I still can't understand that in US, we have a lot of companies building in all technologies to give you real-time access to real-time data, IoTs and whatnot. And our Fed is still relying on the data, which is month old, which is a quarter old data. But it is what it is for now. So Fed is still hawkish. We're not gonna pivot anytime soon until they hit their inflation target of 2%. I think the terminal rate is now 4.7% approximately, to be expected in 2023. So 4.7 Fed rate. I don't know when we saw that last, but that's a new terminal rate that market is adjusting to. So what we had now third consecutively weekly decline on S&P 500. From a housing perspective, oh, that hurts. Mortgage rates, it breached 7%. Which is maybe last it was at this rate probably was in 2008. I don't know how would anyone be able to manage their budgets, because now on an average of, I think it breached, probably it has come down, but still if you look at 6.5 to 7%, remember the start of the year it was 3%. It has more than doubled in 9 months. So if anyone was planning to buy a home at the start of the year, or have gone back, I mean, it impacts them. Yeah, Steve, it impacts the new buyers, or it will impact those who are under adjustable rates. Right. So, and it does impact the other house, the overall market, because now if I were in the market to buy a new home, I am moving. I don't want to, pay off the current mortgage and take on an additional loan at 7%. But overall, I think this week we saw the data was mixed. A new home sales was surprisingly higher in August. But the Case-Shiller Home Price Index fell. First monthly decline since 2012. So the number of new homes that were sold were higher, but the overall prices were down. So are we looking at a case wherein people, the home sellers, now it has become more of a home buyer market, and the sellers are either willing to take lower prices, maybe, and sell it in the market. Overall, year-to-year basis, the prices decelerated from June to July at the fastest pace in the history of this Case-Shiller Home Price Index. So if you are looking for a house, and if you have cash, lot of cash available on the sidelines, maybe it's time to nibble over here. But yeah, if you want to have a mortgage, that's a tough situation to be in. Right. So what do you think is the tough time ahead for mortgage holders? Yeah, adjustable rate. I think if you're on a fixed, it's good. Yeah, this is even higher than what we saw in 2010. That's a 30-year fixed mortgage rate. Look at the pace in the last 2 months. It's been almost from 5% to 6.5%. That is almost like 30% jump. 30% jump in, I would say, a month or 2 months. Jeez. So we also saw another stat, record number of home contracts canceled. So buyers entered into the contracts, but not honoring it. They're walking away from those contracts. All right. Looking at the indices, which gives us the combined picture of what's happening in the market, everything is worse than how it was a previous week. We are down 25%. S&P 500 is down 25%. Year to date, NASDAQ 30%. Everything is below 20. Every index is now in bear market. Right? Even Dow Jones. So when I think I don't know, maybe it was in some WhatsApp group. I sent an image saying bears don't discriminate. Right? And till date, Dow Jones was spared. It wasn't in the bear market because it wasn't down 20% wasn't down 20%, but now even Dow Jones index is down 20%. So welcome. It's what we call friends in misery. all indices are in bear market now. So no discrimination. And not surprised by this number. Fear and greed, dial has turned towards extreme fear. It was on the boundary of extreme fear to fear last week, but now we dial down later further. And yeah, it just take 2 months and for markets to just switch and pivot back in under the fear. So we'll see. So other chart was around the yield curve, right? So recall, yield curve is the most reliable, right? If I can say that, it is the most reliable indicator of recession over decades. Yield curve inversion, and now we are inverted the almost how it was in 2000. And generally, yield curve inversion means your recession could be coming in another around 18 months to 2 years, right? But it also, if it's not just the how much the yield curve is inverted, but also for how long it stays inverted. That also matters. So we saw a brief inversion in around 2019, but that was like for a few days, right? So this time, maybe we will not have a soft landing. Maybe we will have eventually hard landing. And then we saw some of the legendary investors coming and talking about it. Stanley Druckenmiller, the legendary investor who made his name by betting against pound in 1990s, the legendary investor who never had a down year in his investing career, it's saying, no, I think it not down year, not in career, but if I recall, for his fund. But in any case, very well respected name in the markets, and his central case is we will have a hard landing by the end of 23. They say I'll be stunned if we don't have a recession in 23. Now everyone is predicting recession. You open up any financial media, things are bad. Recession is coming. Yield curve is telling us that recession is coming. So we'll see. And so looking at what's all happening in the markets, where do you think we are? And meanwhile, you can think about your answer and paste it. I'll read some other comments. Robert says houses are being purchased by cash buyers and corporations. Mortgage does not impact them. So BlackRock, that have been very actively, have been very active in buying houses, is now looking to slow down their purchases. Number two, we saw a lot of those iBuyers who were actively buying the markets, which was that Open Door, right? They sold 50% of the houses that they sold in August. Not 50%, around 40% of the houses that they sold in August were at a loss. So I don't think every corporation can, the mortgage rate may or may not impact them, but they're not immune to what's happening in the markets. August numbers are delayed. It takes 90 days to close. September data should be interesting. Completely agree. Surprisingly, VIX is still relatively low. Ask me. At this point of time, we should see VIX around 40. I don't know where VIX is because I'm on trading VIX. I switched since I switched to indices, I have not done any hedging trades on the VIX. Yeah, it's still staying close to 30, which is low if we look at what's happening around the market. But okay, someone correct me. Was there a headline around that the VIX is being manipulated by Wall Street firms? I don't know. This week has been very crazy from my work perspective, so I'm not completely close to what's happening on the market. Or in fact, we like slept around 2 a.m. We've got a lot of upgrades happening. So this week has been very crazy. So if I'm not on my game today, pardon me. It does. Let's talk about if marketing case, but I don't know. Maybe I heard somewhere that VIX is being also manipulated. Yeah, Steve, what you say is also right. We also saw a lot of from an institution side. I think there was a chart maybe 2 weeks overshared, which was how heavily those institutions are already hedged, right? And I thought maybe that big hedging could turn out to be a contrarian signal. It hasn't panned that out yet. So maybe that is the reason, because they are already hedged. You don't have to buy more puts, and hence the VIX is not as high as what we would usually see it. Okay. All right, coming back to this chart. Any thoughts on where do you think we are? Well, I like this image, desperation. Are we on desperation? Are we panic, running away from market? Or I'm done with it now? Capitulation and despondency.
Vivek,
yes, Sam.
in 2009, people were telling media was saying, "Don't buy. We're going to have a W recession," and more or less the stock market started rising in March of 2009 and never looked back.
Yeah, that was a bottom. That was a bottom. Yeah,
but the media was saying, "Be cautious. Don't do anything.
Yeah,
don't buy."
So that's a great segue. Is go back, and if you look at the headlines of March 2009, what was happening in the markets, it was all hell broke loose. So that is why I mean, that's why I'll say don't make decision based on what we see in media, right? And by the time media catches up, markets are always ahead of markets are always future looking. So right now there's a pain. So media will talk about the pain which is happening right now. Markets will be rather future looking. Right? So again, I think over here it's not just over a market, but this chart is also dependent on individuals, right? What's your position? How is your portfolio position? Will also depend on is someone panicking? Of course, if you get a margin calls right this point of time, you will be in a panic mode. Someone else whose portfolio is not overly exposed, not too big of positions, might still be okay. So from my perspective, I think not me. Me personally. Now I am at this hope stage. Like, okay, in a few months, let's try to start to add onto the market, right? It might still, no one can time the bottom, and I don't have any crystal ball to say when the market will bottom. But I guess when everything news in the media, every headlines you read is all negative, I do want to take a little more on the contrary side. Not that I'm gonna go whole positive deltas. I'll still have hedge, but I started putting some naked short puts on some of the stocks as well. So we'll see. But I think looking at the collective messages, what I see, and having discussions with friends and all that, For now, the discussions are more towards capitulation and despondency. I have friends who are like, okay, I'm done with this market. This is rigged. I'll rather buy bonds or CDs or treasury and be happy with it. And those are the same friends who were euphoric in when we had some great markets in 2020. Okay. So sometimes the street intelligence also tells you something about the markets. But anyway, this was a good comparison which I saw on the internet from Flame University, that the top signs is large number of IPOs, rapidly rising prices, availability of credit, high trading volume, and your alternative assets also booming, art, luxury, and I would add crypto in here. Financial press and financial TV become favorites. Everyone was watching CNBC while they were in office, still tuning onto CNBC on their phones in 2020s. This time is different. Amateur assets move to equity asset class. I'm looking at Robinhood. They got millions of investors. Social proof leads to herding. A lot of Twitter millionaires suddenly came on 2020. And now, bottom signs, no mergers and acquisitions. Right? Goldman Sachs decided to X lot of bankers on their investment banking area because no mergers and acquisitions, no IPOs coming in. Right? It's been I think, yeah, maybe last week we looked at the IPO stats, wherein the drought in the IPO market, right? It's down 90%, the number of IPOs, or was it the number of the amount of money raised? IPO market is drought. Now, Instacart, I think they're still planning to come IPO before end of this year, but company is not going to raise any money. They just want to give a liquidity exit for their employees. No new money for venture capital. I think I still see money flowing in for venture capital on crypto side, but not on the general side. Low price sales and EBITDA multiples, not surprised. Even if you look at the SaaS companies, from a high growth SaaS companies had enjoyed a multiples of around 40s. Now the high growth SaaS companies have come back to multiples of around 12, from 40 to 12. So multiple contractions have already happened. Recession declared officially. Right now we're saying 2 weeks of, not 2 weeks, 2 quarters of negative GDP. All right, yeah, negative and depressed consumer sentiment, negative front news covers our newspapers and magazines. But we don't know, how long the process of bottoming out will still be there. So guys, do your own analysis. This is more personal. Investing is more personal than more, let's say, intelligent. It's way more personal. So what if I feel it's bottom out, you may not feel that way. So you have to position your portfolio correctly. Last week was death of SPAC. Yeah, SPACs being rolled back, money being returned. Robert says first P compression followed by real earnings compression. So we still have to see the earnings compression. And I think that's what the market or the market pundits are talking about is now the multiple compression is done. In the next, our earnings season, which is starting now, we should see the earning compression. So and there may be some more pain if the earnings will reduce more than what the market has already priced in. Right? Now, there is no model that can accurately predict it, but yeah, that's what I'm hearing. They're saying we still have to see more red in the markets because of earning compression. And we'll see how these companies will come and reduce their forecasts around earnings, etc. Right? But if the if we are expecting it, is it already priced in? How much of it is priced in? That's what, will based on that, the market will move. It's impossible to predict what the market will do. No cheap money to buy back stocks, so earnings will be lower. On the other hand, I think some of the companies, they actually would buy back stocks now, because in 2024 they'll have to pay some extra tax if they I forgot, there was 1% or 1.5% extra tax on stock buybacks, which Biden administration has levied. So there were again two thoughts. Will companies do the buybacks this year to avoid that extra tax? Right. So that's also a factor in play. Impossible to know which factor will, outweigh the other. But I find this chart very fascinating. Or this table comparison. I'm looking, okay, what's happening in the market right now? Right now, the right side is what we are observing. It's very difficult to go against the herd and stay positive in this market. Oops. All right. So end of a month, we finished September, and as always, in the first session after end of a month, I try to share what my stock portfolio looks like. Again, want to be transparent because we talk about stocks, and you could say that I'm talking my books. So I do want to open up and say, okay, what do I hold in my books? So this is as of end of September. Not much has changed between August and September. Is I think Shopify and IWM have dropped off from top 10, and Airbnb and ASML have moved into top 10. Right? Cash is still the largest position. It would have been more if I didn't, because I had filed extension for tax filing. So I did the taxes and had to pay off some good chunk for my advanced tax payments. Otherwise, this would have been maybe close to 14-15%. So I had to let go some cash for advanced tax payments for next year. But still, it is the biggest slice in the pizza. SPY, so Apple, Mercado Libre, Amazon still covers the top 5, and then Microsoft, GLD, which is gold. Surprisingly, yeah, it's almost 3%. Then Google, Airbnb, and ASML. So that wraps up top 10. What other slices we see which may not be in top 10, but Jumia still holding, J&J, healthcare, Teladoc, still a bigger slice. Yeah, that share hasn't done good. Beta, still hold it. Yeah. Any questions? By the way, overall tickers have been reduced from 75 last month to 71. So I'm trying to move more towards because the work is taking a lot more of my time, and then I'm like, okay, then I can't spend time on individual stocks, then I'll move more towards the ETF. Steve says mostly internet stocks. So let's talk about, if you talk about top 10, Steve, Apple, balance sheet super strong. Don't know, call internet, call tech, whatever. Microsoft, core portfolio, great company. Again, cash flow generation. This Apple, Microsoft, Google's are the cash flow generators, right? So still hold it. Amazon, Mercado Libre is a future bet, right? And Airbnb's future, ASML. I just want to hold it because this is the only company. No one else does what ASML does. I do hold others as well. Like say J&J is healthcare, but yeah, I am more familiar and comfortable in owning tech companies because I understand that space better than other spaces. So you'll be in an area where you have the strength, right? So that's where I am. But I do try to, if I don't understand a particular sector, then I'll just pick up the ETF for that. So I have XLF from a financials perspective, IWM. IWM, well, if right now it's not on top 10, then probably it is slipped down to 11, 12. No internet security. I have CrowdStrike, but probably not big enough to feature in this pie. I do hold CrowdStrike, and that is my, I think, the only internet play. Cool. All right, let's move on. Some positivity in this all doom and gloom, all red markets is Alzheimer drug. Correct. I've been seeing this for years. This is one, the whole world is waiting for some treatment for Alzheimer, and we saw some positive sign this week. Is experimental drug made by Eisai and Biogen. They showed better results. I think it was 27% result, better result as compared to placebo. So let's see if this is going to be, if FDA approves and insurance companies, are ready to reimburse. Basically, CMS is and Medicaid are ready to reimburse for this. This could be as big as a Lipitor drug, right? These are the multi-billion-dollar drug area, especially the Alzheimer. And Biogen and a lot of other drug makers have been working for years, try to find an effective treatment, but nothing is on the markets yet. So we did see, I think it was last year or in 2020, Biogen got an approval for one of the drugs. And all those drug names ends in MAB. So I don't know some drug name. I'm not from pharma industry, difficult for me to remember these crazy names. But then I think CMS told that they won't reimburse for it. So Biogen just pulled that drug out of the market. There's little controversy in that drug approval. FDA advisors were not in favor of approval, but FDA still did. They went ahead and approved it anyway. But then when the biggest insurer declined to reimburse it, there was no market for it. Anyway, so this time, Biogen is more hopeful, and now Eisai, they are now seeking FDA approval under accelerated pathway, with the decision expected in early January, because I think this time they are able to demonstrate with some, that it's able to decrease the progress of Alzheimer by 27%, which is a big enough margin, right? So let's see what happens. But the market already, showed its reaction. It loves the news. So Biogen shares were up 50% on this news. And this stock was trading close to 200, or rather 195, and ended up 280. So if you're Biogen shareholders, congratulations. I don't hold shares in Biogen because I've seen this story before also. I'm very happy that we are getting closer to finding a drug for Alzheimer disease, this which is impacting, I think, millions of American, if I recall, 13 million, or was it 55 million? Was it 55 million is global? I think Americans around 13 or 20 million. So yeah, if we can find a drug, that will be great for humanity. But over past many years, we have seen these ups and downs. We saw this in 2021, we saw this in 2020, and surprisingly in 2020, it just reversed in one day. So I'm not chasing this, chasing Biogen. I'll wait. And if really gets approved, if insurance companies really start to reimburse, Biogen has years to make, a lot more money through this drug. So we will have a lot more time to purchase the Biogen if you are interested in the stock. Again, not a stock recommendation, but if you want, we'll have a lot more time. Right? Every time there is a little hope, we see the stock market jumping, and then reversing its course because, hey, this didn't move further. It's a tough problem to solve. Robert says real cure for Alzheimer is to stop using fossil fuel-based nitrates, ammonia, fertilizers in crops. So we have to make a decision on whether to feed people or whether, have them remember who they are. So tough choice. I mean, even the cancer is because we're using too much of our chemicals everywhere. So all right, the other positive news, hopefully a little positive, is as I mentioned last week, we'll open up the weekly webinars recordings for everyone. So if you are a basic member of the website where we post, if you can confirm or check at least the last 1 week, and now in the future, we'll have all these recordings available to everyone. I'm trying to do my best. In this scenario, where everything is doom and gloom, let's read some positive news. All right, what next? Don't fight the Fed, right? We always hear this. Fed knows it all. Fed is, they got 400 PhDs under it. But a few sentences that I was reading tells me even Fed doesn't know anything. Surprisingly, the Fed funds rate is not a market determined interest rate, which is true, but it is set and controlled by a Fed, which is a set of 12 regional federal banks, which are not government entities, but are controlled by private banks. The holdings is mostly with the private banks, but nobody challenges. So it's a private bank owned consortium. Yet the FOMC members, Federal Open Market Committee members, were infamously terrible at forecasting on what they themselves would do. In 2015, average projection of 2016 fund rates was 0.9 and 3.30. Forget about what they talk about, what markets will do. They themselves are way off on what they will do. Right? The actual numbers were 0.38 and 2.38. Earlier this year, bank believed inflation is caused by friction, the reopening of the economy, and it was only temporary. Only late it reversed its gears and now have admitted that the inflation is here to stay. So faulty Fed forecast results in a faulty forward guidance and increased financial market volatility. So I don't know that the Fed has now got a crystal ball to say, okay, inflation is here to stay and we will continue to be as hawkish and we'll take the terminal rate to 4.7 by 2023. So I am taking markets based on what's happening in the market and not what Fed is saying. Stay a little hedged, don't get too big, give ourselves room for error because nobody knows. Even Fed doesn't know what it's gonna do. Fed has no crystal ball either. They've been wrong again. It's like we're turning the steering too much in one direction, and now we're turning it on the other direction, right? Why can't we just, I don't know what is Fed trying to do here. So Robert said Fed is a cartel-based private bank. Yeah, so when I was looking into the history of Fed, I was surprised, because the impression is that this is a government entity. Then I realized, no, it's the individual stakes are held by private banks in the regional those federal banks. Anyway, so don't fed the Fed. Fed put is no longer available, but I don't know, based on what we are seeing in Bank of England. Let's say Fed continues to be hawkish here, and we see in Q1, Q2, or Q1 of next year, things start to break. In US, maybe we'll just, kick the can down the road again. Once again, we've done it for years, could do it again. So too many variables to make any predictions. So other question I have is, and this I was listening to someone, I thought I'll talk here, is Warren Buffett the most intelligent stock investor? What's your thought? I know he's the most respected one in the investing community, but he's the most intelligent stock investor. Any thoughts? Right. Other thing I heard was, if Warren Buffett would have retired like common people retire at the age of 60, would he still be the Buffett that he is today? Definitely not. He's not the most intelligent stock picker. He's not the most intelligent stock investor. I mean, he never looked at, he never could anticipate the technology and the growth in technology companies, right? Completely missed the boat. No Amazon. He got on the boat very late in the game. Only technology bet that has worked for Warren is investment in Apple. That too was not driven by Warren. I guess that was driven by his two lieutenants, whom he brought on board a few years ago. Warren picked up IBM, right? Didn't work out. So definitely he missed the last 15, 20 years, wherever the market, the biggest driver of the market returns. Warren missed that. So definitely, I don't call him as the most intelligent stock investor. If you're not looking at what the future trend is, then from intelligence side, then you're not the most intelligent. Robert says all intelligence is subjective. True. Kunal says he may be a good resilient investor by sticking to stock choices. Yeah, we'll talk about that. And SP says all his money was made 30 to 50 years back. I disagree. The stats show Warren Buffett made 99% of his money after age 50. So today he is 92. 99% of his net worth was he made after his age 52, after age 50, and 95% of the money he has made after age 65. So if he would have retired like who you and I will retire, he wouldn't have been the Buffett. Of course, he would have still had $1 billion, still good enough money, but not, many other people have. There are many billionaires around. So it's not that he's the most intelligent stock investor, but he is been investing for the longest period of time. He started investing when he was 12 or 11. That's when he picked his first stock. So Kunal, coming back to your point, It's a resiliency. That's why we know Warren Buffett. And I don't have the stats, but maybe we should look at and see Berkshire returns every year and find, I don't know if someone has already done the study, and see if those were the best returns made by any funds. I bet probably not. So he's not returning, he's not giving he has not got the best returns, but he has got the okay returns, but the longest period of time. That's where he's enjoyed the magic of compounding. There are many firms, many hedge funds, many mutual funds, many more investors who would have outperformed by leaps and bounds in one particular year, or maybe 2 years, maybe 5 years, but then they fizzle out. What I like about the more and more I get active on the market or trying to understand economics and more around investing philosophy, for me, looks like resiliency or being in the market. Be able to let compounding work in your favor is the only thing that we need to do. We don't have to really pick Amazon of the world. He never picked. But look, his investments are all mostly in very stable old economy stocks. But the fact that he's held on to that investments for 80 years, right? 80 years is his investing career. So it's resiliency, it's being ability to not make a bet that will throw him, out of the market. That's a very interesting, when I was looking at the stats, it was a little eye-opener. You don't have to be really intelligent. That's how I used to think. Oh, I need to understand, get in the details. I need to have good IQ. You need to understand, all the nitty-gritties of these companies. But I think it's all the resiliency. Don't make too many big bets. Make sure that you're not panicking and getting out of the market when the times are tough. Because other stats, there was actually a study by JP Morgan around, if you take out the 10 best days over like the last 20 years or somewhere, and the overall it was conducting the performance around the market. If you take out your 10 best days, then your returns are like cut down by more than half or something like that. And those 10 days actually appear within the bear markets, and we never know what those 10 days are. So that is why I'm like, I'm not getting out of this market. I hear a lot of people moving to cash. I might slow down if I need, additional cash, but I'll still stay invested. 401k is still going in. 5 to 9k is still the way it was. Haven't touched those investments. Haven't touched those recurring investment into the market. And making sure you have your hedges or know how to hedge a portfolio so that you can stay longer in the market. And then even if you have not bought the best of the companies, we might still be able to beat the market. We don't have to pick Netflix. We don't have to pick Amazons of the world. That's my learning about reading about his investment style. So there are a lot more people talk about his stock picking style, but not about how he is. And most of the people that we think, there was an interesting quote that I read on Twitter. Let me recall, which was saying, Warren Buffett is 90-year-old and has an investment horizon of 30 years, something like that. And then the 30-year-old people have smaller investing horizon than Warren Buffett has. And then everyone wants to be investor like him. Doesn't work out. It's a lot more around your psychology, which determines the success than stock picking capabilities. SP 10-year return is 203%, and rolling 10-year has been greater than 100. The same for SP is 180, 60 over 10 years rolling period. Yeah. So I think last 5 years, Berkshire hasn't done good. It has underperformed the market. I don't know about 10 years. But look at the overall of the history of Berkshire, great. Again, I'm not saying we have to emulate. All I'm saying is there are other factors that impact our portfolio returns than picking the best stock. What good will, let's say, be picking Amazon, and then, when Amazon was 50, went down to 90, fell down to 6, and then you got us saying, I'm done with Amazon. And we never enjoyed. But now Amazon come back to 2,000 from $6. So there are, I think, many more people who are way more intelligent than Mr. Buffett in picking up the right company, right technology, and the right trends, but probably doesn't have a wherewithal to go through the turbulent markets or through the turbulent period in a stock, which will always come, right? That is the destiny. If you're in the market or if you're picking a stock, we will have a times when it is down 50%, 60%, 80%. Right? And my opinion is 25% of my stocks that I hold in my portfolio will go to zero. And I'm okay with that. And that's, I hold 70 shares. I understand 25% will go to zero. But I want to make sure I can still, but biggest problem is which are those 25%? I have no idea. So that's the tough choice. All right. Related to this, saw another note, actually churning your portfolio, trying to gain edge. Hey, let's get out, let's get back in. Only 40% of the 30,000 active funds outperform their average passive P over 12 months through June. While this is the market when those active funds should be handsomely beating the indices, right? Those are fund managers whose job is, hey, the markets are going down, we will get you out of the market and we'll buy at the bottom. And now this is the perfect time because markets have been volatile, right? But only 40% of them were able to do it. And 60% of them failed, right? I think that was one. So that's why I'm not trying to beat the market by trying to time it, because for me it is impossible. When professionals can't do it, what to talk about us retail investors? But when I'm on some Twitter space, a lot of so-called investors talking about should move into cash right now. Markets are turbulent. Next year is going to be worse. Dude, I have no idea. And I don't think anyone does have. Amazon Prime too. I'm an Amazon shareholder, but I'm not a Prime Day shopper because I think Amazon gives the deals across the year, and I generally don't have anything big to. I don't know if I need anything big right now, but now Amazon is doing Prime too, not just one Prime Day shopping, but doing another Prime Day shopping on October 11, 12. I think the Prime Day is somewhere in June or July. Now they're doing another, is October 12th. They announced it on Monday. It's the first time when they're doing it. Why? Inventory.
Vivek.
Yeah.
I'm very disappointed that they have it 2 times a year because I already joined Prime for a month so I could get it in the sale in July. And now they have it twice. Like Singles Day in China, it's not one day. I think it's a whole week or something like that.
Yeah. So Amazon had to get rid of inventory, man. It's killing. So again, impossible for anyone to forecast what's going to happen next. COVID, shutdown, lot of demand, every company over ordered, right? We saw this is in Target. They ordered a lot of stuff, which they over ordered, and now they were having a lot of inventory issues. So the Target stock got beaten up by that. Then they had to put everything on sale. Stuff like a lot of your patio furniture, big stuff, your beach stuff, your couches and all. So Target had to get rid of that inventory. We saw Nike, right? Nike had its worst day in its history because glut of inventory. And these are one of the best companies in the world, Targets and the Nikes, whose job is to find out what to stock, what not to stock, how much to stock, and how much not to stock. And they are not accurately able to predict what inventory to keep. So Nike, when they came out with their results this week, I don't know the result. I don't follow Nike because I don't own the stock. But when I heard that Nike had its worst day in its history from a stock performer, what the heck? It was all about a lot of inventory sitting with them. So Amazon is trying to do, trying to put a lipstick on the pig with saying, guys, you also have too much of inventory. What a nice way to get rid of that inventory by doing Prime Day 2. Otherwise, why would they? I don't think they would have done it if they were also not having supply. I think Amazon understands that there is too much of inventory. Everyone had ordered a lot, thinking you don't know how long this COVID will continue. And now they can't figure out what to do with all that product. So I think that's the reason why Amazon has resorted to doing Prime Day 2. So we'll see how successful will that be. Other biggies like tech company, and from Amazon, now we have Apple. Apple stock dropped on concerns about iPhone 14. Right? So this week, Apple is down almost 8%, 8.5%. What's happening with this company? No one wants to buy iPhone. No one wants to go and stand in the queue, night before so that they can get their hands on the latest iPhone. I think maybe market could have overreacted. So what Apple did was they did. So I think they've gone back to what they mentioned at the start of the year in terms of the iPhone demand. So some of the headlines were not really telling the full truth. It's all the play of the words, right? So the headlines were headlines suggested that Apple is seeing slowdown in demand, but the actual thing is Apple told that the additional growth that they were expecting is not going to come in. Then they're just not thinking that the additional growth will come in. So Apple had given a guidance at the start of the year. Then they came back and revised. They said, I think we will probably have more growth on iPhone 14. Now they've gone back and saying, I don't think we will have a growth in that additional growth in iPhone 14. So they're still holding back to what the estimates and the growth projections they had given during the start of the year. So it is still growing, but just that the additional bump that they were expecting is not going to happen. That's because inflation is still high. People, consumers will think twice before buying a $1,000 plus phone. Right? So that's all. It's not that they are seeing slowness. It is just that the additional bump that they were expecting will not have that. But anyway, Bank of America downgraded Apple stock, so it had double whammy. One was this news, and then the Bank of America analyst came and downgraded the stock, and then the stock was I guess I was saying at the start of the session, I rarely see this, that Apple is the worst performer in the portfolio. You never see those things. But yeah, it happened. So now Apple is at what?
Vivek,
Yeah, go ahead. Let me. I'll pull it.
you see, I wrote reduce prices. Actually, I tell you, unlike any other year, they're reducing the prices of the MacBooks. Unlike any other year for the past 20 years, well, 15 years, yeah. They didn't reduce prices before 2011.
Yeah, so Apple is diversifying because they now the other news I saw is Apple is also moving the manufacturing, some of the manufacturing capacity over to India because they want to manufacture cheaper phones in India for the local population, right? And it's fair. You can read the news in two ways. One is like, oh, Apple is under pressure. That is why they're moving towards the lower segment or less affluent markets. Other way to read this is they think they can, expand in that market. The affluent market is already captured. So why not? So there are two ways to look at the same thing. And we talked about this over this applies not just to Macs, but to phones also. Apple creates $1,200 phone. Plus now they also start to look at, what OnePlus is doing, what Huawei market is. And if we can produce a phone cheaper and give that aspirational iPhone brand for the people in developing countries, then why not? So anyway, there are both from my perspective, I think I am still hopeful on Apple. I am not of the camp that Apple has lost its charm. Yeah, these things will come and go, but look at the services revenue. No one knew. It wasn't even a place in the P&L statement 5 years ago. Now the services revenue, what is $20 billion business? I don't know. I mean, we will again review it maybe in the next earnings call when earnings come out. That's become a much greater part of the business.
Vivek, the problem with Apple is 15 years ago, they only had one iPhone. 15 years ago, they only had one MacBook. Now they have like, I don't know how many iPhones, like 5 iPhones.
Exactly, and, right? Now they are capturing every price point.
No, it's ridiculous. Well, no, they're not reducing the prices of their iPhone. I mean, if they're reducing the prices of their iPhone, they should reduce the prices of last year's model right when the new models come out. But they don't. They still
Apple knows who will still buy the expensive ones, which areas expensive will continue to sell. I'm sure if the lower prices start to cannibalize the sale of the higher ones, they'll figure out. But I like the strategy. Why not capture we have already cornered the high end of the market. Let's move towards lower one. But what didn't get reported or analysts and all of that missed is Apple Music is now a sponsor of Super Bowl halftime show from next year. Pepsi is out. Pepsi has been the sponsor for godforsaken years. I don't even recall, maybe for a decade more. But now Pepsi is out and Apple Music has stepped in. Not only this, so now look at Apple is now trying to associate themselves with sports. And not just this. I also saw Amazon's deal. Amazon Prime bets big on NFL Thursday night football. So Amazon did a deal with NFL for it's $1 billion deal. So there are now we're talking about 2 NFL deals, both by the tech companies, so-called tech companies. One is Apple. It's a 5-year, $50 million deal for the halftime show. What is 15 minutes, 20 minutes halftime show? Then Amazon doing $1 billion a year deal with NFL for next 10 years to have exclusive Thursday night football exclusively on Apple or not Amazon's Prime streaming service. It's not telecast anywhere else, but only on Apple Prime. So now if you are, want to watch NFL Thursday night, have no option but to go to Amazon Prime and sign up for Amazon Prime. And this is, I believe, these things are not even priced into, nobody's talking about these things. The reason why these companies are moving on to the sports is 75 out of top 100 TV programs are all related to sports. Americans are crazy about sports. And this is where you can make a lot more money. In fact, for Amazon Prime, on the Thursday night, where's the stat? Oh, I didn't put the stat here. When they announced, when they started streaming this, the Amazon Prime got the maximum number of new signups in a 3-hour window ever in the history of Amazon. Ever in the history of, so no other time in the history of Amazon Prime that more people have signed up for the Amazon Prime service than it did on the NFL Thursday Night Football when they did it, on their first streaming telecast. So Amazon knows how to, will figure out how to encash those, right? So $1 billion deal for next 10 years. From an NFL perspective, NFL wants to attract younger crowd. I think that the average age of football watching crowd is 48 years, 48 or 49. There was some stat. Right? But NFL wants to move towards attracting a younger generation. Where do you find younger generation? Not on cable TV. You find it on the streaming services. Younger generations have Apple Music. They stream music. They don't have cassettes. I mean, I used to have they don't have a cassette player. So no wonder we are seeing these tie-ups and a lot of money on the sports television, and why these Amazons and the Apples are entering into this arena. So that was a fascinating stuff to know. I didn't know about this whole sports stats. So it was a big learning for me. 75 out of top 100 are sports programs. I'm not a big sports fan. I don't watch too many sports programs. So would have never known. And I was questioning, why is Amazon going in here? Now I understand why they are getting into this. Who knows what they might come up with next. So two so-called tech companies moving into sports streaming. Isn't that crazy? We don't associate these kind of brands with NFLs ever. All right. So I'm still bullish on Amazon. I know the stock has got beaten down. Where is it? $113, $15? 113. But I'll still hold in my portfolio. Both are top 10. New thing. When the times are crazy, we see a lot more crazy stuff coming into the markets. Now we're having single stock funds in the markets. So far, the ETFs that we know of is, hey, I don't have a time and capacity to analyze a particular stock. I'll buy an ETF for that particular sector or a subsector or for that industry. That's how the ETF industry has evolved. I mean, you don't have to take a risk on a particular stock name because you don't know it. So let's buy an ETF, which is a basket of stocks under that particular ETF. But now we are seeing a lot of ETFs are coming in which bet just one stock. Hell, why not just then do whatever you want to do with the stock itself? Why you need that ETF? Right? Why? Because these ETFs allow investor to make outsized bets, bullish or bearish, but could be a leverage bets, right? Could allow them to do things that we as an option side can do, but those who don't understand our options, they can use some of these ETFs. Right? So now there are a few ETFs which are, let's say we have a Tesla bull ETF, 1.5x of Tesla shares of daily returns. So now, if you want to take a leverage bet on Tesla, you could buy TSLL. And the lot more crowd that is coming to the stock investing, especially last 2-3 years, are ready to take these weird leveraged inverse multiple X ETFs, right? So when you have a crowd that don't understand the risk but are willing to take it, market will come and sell them anything, right? If you don't understand the effect of a poison and want to take it, there will be companies which will come and sell poison to you. So that's exactly what we are seeing. Now there are ETFs that are on a single stock. You can take leverage bets, bullish or bearish, either way. Okay. And yeah, it does some purpose that you can only lose what you've invested in ETF, right? You don't have a margin. If you have a margin, if you have to take some of these leverage bets, or if you have to trade, you can do all these things with the derivatives, right? But if you don't understand how derivatives work, or if you don't have a margin account, and you don't know how to contain that risk, then hey, I'll take this ETF. I can't lose more than what I've invested in that ETF. But why these are big? Why these companies that are coming with this? Oh, huge expense ratio. Right? 1.15%. It's like more than 10x of the normal ETFs. Right? Yeah, this is a mechanism to separate money from the uninformed. Oh, you want to get high? Yeah, I'll sell you a little drug. That's exactly. And it's not illegal. So why not? And then will come a disclaimer: inverse and leverage are not suitable for investors with a long-term view. Retail investors are not going to go and read all these things. They were not going to understand that how does 1.5x leverage with the daily tracking can kill them. Even though the stock has gone higher from the day when they purchased it, their investment is still lower. They still lost money, even though they had 1.5 times leveraged. No one gonna get into how does the daily tracking mechanism works. Okay. But whether you make money or not, this company, which is issuer of an ETF, and they made their money because the expense ratio is 1.15%. Again, I think there are always a question on leverage one, and I always say leverage. If you want leverage, have a very, very short-term time horizons. Leverage funds are not to be inventoried. And today, when those who are thinking that okay, we are now bottoming out, I should maybe buy 1x or 2x leverage funds because next year will be better and might be able to double my money. Doesn't work that way. If you bought leverage fund on QQQ today, 6 months later, QQQ may be higher, but you would have still lost money. Understand how this mechanism works. But yeah, well, who cares? Companies won't care. They can make money on the fee. Right? Again, we'll come and talk about it, that only those who are actively trading on daily basis should use it. Anyway, so, and I know the Consumer Financial Protection Bureau, CFPB, they have some concerns on it, but so what? Now, you could do some of these things using derivatives, That's what I do, but I understand the risk and the rewards around it. But now, because this has become an ETF, this has opened up floodgates for everybody. Right? And the risk is that it would entice amateur investors into risky and speculative trades, just like the meme stock had done. This is a new type of meme. All right. Not everything is bad. Now, there are some single stock ETF that will limit the risk. Right? There is one which is called Investor Hedge Tesla Strategy ETF. Right? And this is exactly the same thing what we talked about 3 weeks ago. What's those buffered ETFs? Now, this is a buffered ETF, but in a single stock. So if you're holding Tesla position, this is nothing but putting a collar around Tesla, right? You sell a call and you buy a put. Now, you could do it yourself, or you could buy this TSLH and give them 1%. But that's not exactly what they do. Is you buy a put at 10%, go 10% down from a current price, buy a put, and then you go and sell a call at around 10% higher. That's exactly what this fund does, and that's what they put a collar around it. Right? So crazy stuff. We're seeing a lot more new financialized products coming in the market that we hadn't seen earlier. So yeah, be careful. I'm seeing more and more of such so-called innovative funds, because now everyone is got spooked by the market, looking for protections. So such funds with a high expense ratios are now doing the rounds, be it on the annuity side, be it on the ETF side. And now we got a single stock, how you can hedge a single stock position. Right? So be careful. All right, so I think that was all on the what caught my eyes. Let's jump on to DocuSign. Before that, anything else that caught your eye? And like I said, I didn't have too much time this week. Has been crazy at work. So sorry if I'm a little off today. I have to catch up on the sleep as well. Tesla bot. Yeah, Tesla AI Day is coming up, right? When is the Tesla? Oh, you're saying okay, this is Tesla bot. But good, try to remind you, Tesla AI Day is coming soon. Oh, it was yesterday? Or did they have a dancing robot? Let's see, did they, let's see if Tesla had some dancing robot. What did they announce? Okay, oh, that's why you're saying Tesla bot. All right, Elon can do whatever he wants to do. It says unveils prototype of humanoid robot. Optimus. Okay. Yeah, we'll have to see what it does. I don't know what happened to the Cybertruck. No, he doesn't talk about that anymore. This is one of those deflecting tactic of Elon. No news around Cybertruck. How about those robo-taxis? All right, maybe I'll spend some time. Hopefully this week will be a little better than the last week to see. Oh, no CT, no semi update. I don't know. I mean, this is the only reason why I'm not bullish on Tesla is because of Elon. But the stock keeps going up because of Elon. So it's a weird, I have a weird relationship with Tesla. I mean, this is, yeah, you can say, hey, I didn't make money on Tesla, gone up, but I just can't put my head around how to understand this. The CEO is such an eccentric CEO. All right, thanks for the link. I will watch what Tesla did on AI Day. They also have stocks on Nike, Nvidia, PFE. I guess the single stock. Yes, so they have on. I think they got approval for almost 10. So got Tesla, Pfizer, Nvidia, PayPal, Nike. Then other issuers have Apple, Coin. Yeah, but I think this is again like transfer of wealth from uninformed to these who sells this. All right, let's get on to DocuSign then.
So this is a company that I think we talked about more than a year ago, and a lot of things have changed in this company since then. So let's look at what this company does. Name should not be, maybe most of us should be familiar with it, but let me not be presumptuous. Anyone who does not know about DocuSign or hearing this name for the first time, nothing right or wrong. I mean, I don't know about many companies because I don't have to deal with them. Now, everyone has heard about DocuSign. Okay, who all have used DocuSign? Have you used DocuSign? Close my refi. Bob says never used. Mono says yes. Yeah, a lot of retail investors or retail, people only know about DocuSign when they're trying to sign the mortgage documents. So that's the best use case, Ramesh, is closed my refi. And then that's our first experience with DocuSign. Nowadays, I also see if you join a company, a lot of the documentation that you sign when you join a new company is electronic signature through DocuSign. As the name suggests, it's document signature. Pretty much a household name. Yeah, if you bought a house, then you'll probably know it. Signed option authorization with Vanguard through DocuSign. Yeah. All right. So what does DocuSign? What it does? Basically it is the most known for a product called e-signature. They want to be the party providing a ways in which the world agrees, the participants agrees to do something, which means it's an agreement, and they are changing the way in which the world agrees. That's their focus. So let's look into their product suite. Signatures we all have used. What else do they have? Look at some of their financials. We will look at the stock also. We'll talk about some of the changes. Okay, sound is muffled. Okay, I don't have any internet issues. Hold on. Let me see if the mic.
Okay, is the sound better now? Okay, cool. The other part of the session. All right, let's jump into DocuSign and see what they do. All right, so we have their investor presentation, transforming the foundation of doing business, because when it comes to business, it's all about agreements, right? Agreements are the what have I do? Is something really going wrong today? My PDF suddenly shut down. Okay. Okay, agreements are the part of any business. Doesn't matter what part of what department, what business you are in, which department you're working in. It is whether in sales, tons of agreements, reseller agreement, customer account agreements, loan documents, marketing, promotional agreements, and services, your field service, your policy, cancel it. Every department agreements. What we have to deal with generally is human resources. When we join the company, you sign a lot of agreements. Right? This is what I'm going to do, do's and don'ts. Your uh, new hire, your offer letter that we accept. That's how it starts. You're accepting the offer letter. That's an agreement, right? Your non-disclosure agreement. I'm not going to talk about companies' IP property rights outside, right? Non-competing agreements. Um, if you're in finance or IT, your asset tracking, your asset management agreements, legal NDAs, legal team anyway does everything. All they do is an agreements. So every agreements are the foundation of doing any kind of a business. Agreements were manual and disconnected, right? If you had bought home 15 years ago, why 15 years ago? I think when I bought mine 7 years ago, I had to sign a ream of paperwork. Went to the title company, sat down and signed a lot of paperwork, right? It was all manual. You create, you collaborate, sign it, and then go through all this process of 4 phases of preparing, signing, acting on it, and then finally you store wherever the agreement needs to be stored. Nobody wants to do the paperwork, and COVID forced everyone to move to completely online anyway. So the first product what they did was do a e-signature. That's what transformed the whole business. So now it's so cool when you're signing a refi, the signature over a signature process is pretty cool, right? Yeah, we don't read through it, but I don't think we, even if it was a paper signature, I would have read each and every sentence of those 100 pages that we have to sign, right? This DocuSign or any e-signature, forget about just DocuSign, there are competitors also, make it very, very easy, very cost effective to sign any kind of a document. I mean, we use it to sign customer contracts, right? Your master service agreements, your statement of works with a customer, we use DocuSign with our customers. NPS score of 70, which is Net Promoter Score of 70, is really high when it comes to, from a customer delight perspective. So this was the initial product that this company started with, is let's make the whole process of signing the documents easier. So no wonder in 2020, when we were locked down, meeting a notary who comes with a tons of documents for you to sign wasn't an option. DocuSign just blew the socks off, and the stock was gone just ballistic. Let me go back. Right, huge growth that we saw in the business as well as on the stock side. Right, but of course it hasn't done that great since then. So I do see some comments. Lena says, I've been heavily shorting this one on and off, but they are profitable, not going anywhere, but trading it. You can actually play both ways. Short right now is for sure one due to the way tech stocks are getting traded. Yeah. So again, it was a high growth stock and got the COVID tailwind, just like any other businesses have gotten it, right? And now there's a multiple corrections that have happened, so the stock has also come down. But let's talk about what else they're doing in the business, then we can get to the stock. So this was their initial start. but what the overall business would be, which is what they're looking towards. Let me go to how they have changed their business, right? So this is how they started in 2018, right, with e-signature, and they were leaders in e-signature. And most of us know only because we use DocuSign for e-signature, right? But then they acquired Spring CM, another company, which is basically around not just signature. Right? When you have to talk about any contract, there are a lot of things that go in contract. Who's going to produce the document? Signature is later, but first the document has to be produced. Then it needs to be signed. And in some cases, if you're in a corporate buyer, it's not one signature. It's a level of approvals. There will be workflow around it. And then after that is signed, who needs to have the copies, where the documents will be stored, for how long will that be stored? If it is a financial document, may have to store for 7 years. There are some regulations. There are a whole lot of stuff that goes into the managing the contract life cycle. Signature is just one part of it. So they started with the signature. Now want to move towards contract life cycle management, and that's why they acquired a company called Spring CM. Right? Acquired another company called Seal for running the AI analytics on the contracts. Right? So today, and I'm assuming that this AI analytics is type of today. If I were to sign, if I'm getting any contract, how do I know, what are some of the red flags in those contracts? We can very well use AI to do it, right? If I get a red lining on the contract from a customer, and how do I know, which is favorable, which is not favorable, which one I need to weigh in on? Today, all that process is manual. And this is the one part of my job that I'd hated over years is we send a contract to customer, they'll come back with redlining and we go and review it, and there's okay, what else we have changed and all that stuff. It's a painful, no one wants to do it. But unfortunately, my lawyers won't let me go ahead with the deal if we haven't done that stuff. They also acquired Live Oak, which is a notary. It says, we all know the standard way notary works. Either call up your bank, many of the bank provide notary services, or you have an individual notary, you go to them, to show your proof, get the signatures, then come back and all that. Now you could actually, DocuSign is providing notary services online, right? So that's another market. And finally, they also did a clause IO for smart contracts, which I'm assuming that it can actually create a reminder contract for you, depending on what the asks are. So anyway, starting from a $500 million 12-month revenue run rate, now they're up to $2.1 billion in 2022 in 4 years, right? This is basically their journey that they're looking for is almost $50 billion TAM. It's this total addressable market, right? Start small with the signatures, move into the overall cloud, agreement cloud, and then deepen the automation and AI with smart agreements. So that's how they are looking at from a overall growth or a product life cycle perspective, where they want to go, right? Okay, so yeah, so from application, these are the three main, I would say, product revenue generators for them. And the biggest chunk of our revenue, still they don't break up the revenue for these segments. We don't know how much is what, but given that essentially most of their business is what they started from their e-signature, we believe this is still where they make most of their money. And then on top of it, just from not just signature, they started selling additional services, which is notarization, industry specific signature and the workflow, etc. And then the third one is a contract lifecycle management, which is, I guess, a pretty new one. But this will where the most of the future growth will start to come from. Right? But remember, these are completely different products. Here you are just selling a signature. Here you actually in a CLM, you're actually selling the story of how the overall business process improvements and your around your contracts management. So it's a different way of selling it. You need a different people to sell it, and that's why we also saw churn on DocuSign, right? So yeah, we talked about that, looked at this. E-signature, they're still the leaders. They are 1.28 million plus customers, which include even the individual customers, right? But that's not where they make most of their money. So now from an e-signature, they add on to a little bit more add-ons on this one, your identification, notarization, etc. Then this is their contract lifecycle management, where you can generate the agreement, have a negotiation on the cloud, track red lines. I love this, and ensure version control. Uh, this is where most of the money will be. Right? Some I think maybe will this make it also an acquisition for Salesforce. I don't know. I'm just throwing this. Now within the CLM, they are looking at get your foot in and then expand. Right? Essentials, doing automating the basic contract busy work, right? This is what the busy work, you actually create a contract and then you customize it based on your individual customers. So today we have our standard rates, but then for some of our customers, we have a negotiated rate. So when you have to create a contract for that, you have to do all those work manually. But these are some things that they can do it with CLM Essentials. Then add CLM, then give a little more capabilities with the CLM Plus. So different tiers of contract lifecycle management products, right? Across all verticals, everyone needs to have agreement. So I don't think there is any vertical. Whenever you're doing, so business is nothing but an agreement between two parties, right? Whether it's a verbal agreement, some cases just a handshake agreement, but majority of the business is still done through legal agreements, which is on paper. So the, their need is across everywhere. All right, let's this. Okay, let's jump on to, yeah. So this is how they will planning to expand and move on. Is just from a single signer to make them the business as a customer, expand them, and then also do integrations, which is okay. You're using Salesforce. How can we integrate your cloud, your contract management with Salesforce? Or you're using SAP, or we do have an integration across this SAP and all that stuff. So again, so let's look at a little bit on the financial side and how they make money, and then maybe we can jump onto some of the little bit what else they are seeing in the future, right? So on the financial side, how they bill their customers, right? So they bill it based on two factors. One is what kind of functionality do you want to use? Is it just a single signature? Like if I'm signing an employment agreement, it's just I and maybe the the finance CFO has to sign, or whoever is leading that HR has to sign. Is it a multi-user? Right? Many contracts, if it is more than a certain value, needs to be signed by two people. Yeah, the hiring manager has, let's say, yeah, the purchasing manager has to sign, but if it is over $1 million contract, the VP of the procurement also has to sign. Right? Is it going to integrate with your internal system? So one pricing is based on what kind of functionality do you want? The other set of pricing is based on volume, right? How many signatures are you looking at? So DocuSign has a concept of called envelopes. How many envelopes do you want to send across for signatures? Right? Let's say if it is in a workflow and I have to sign, my boss has to sign, and the CEO has to sign, then I need to make sure I budget for 3 envelopes on one contract. And I know, okay, maybe I'm gonna sign 50 contracts this year. I'll tell DocuSign I need these many envelopes. So that's based on the volume. A mix of these two, the functionality and the capacity or volume determine what's the price would be, right? And then I sign a contract with DocuSign saying, oh, for next 12 months, I want to buy these envelopes. Right? Now, if you look at the dollar weighted average contract length, 1/3 of their contracts are more than 12 months, higher than 12 months. So on average, you look at it's at 18 months is their dollar weighted average contract length. Some contracts could be very small. I just need to, it could be a transactional in nature. It's like your signatures for refi. The mortgage company probably will have contract with them. I need to buy 10 envelopes. Okay. Some contract, which is mostly enterprise, could be much longer in duration. But on an average, it's an 18-month contract, which is great. It means you could have a predictability, or at least you have a company that has committed revenue or committed bookings for the next 18 months, right? So that's how their model works, is a prepaid model. Let's look at the revenue. Like I said, now they've been seeing consistent growth in revenue, 39%, 49%, now 45%. Of course, it has come down as compared to what they had last year because COVID accelerated the online digital adoption. And this is no different than what we are seeing in the other internet companies, wherein now they have a tough comps as compared to last year. And also the subscription revenue grew similarly. Now, 97% of their revenue is subscription, which is renewed year after year. Right? So you have a lot more predictability, and these 3% is wherein you get revenue from doing some one-off work for a particular customer. But 97% is what you'll get year after year. This is like your cable bill. This is like your streaming services bill. You pay it every month. Recurring revenue, right? So not surprises here that the growth is has slowed down because in financial year 2022. So for their perspective, right now it's a financial year 23. So when you talk about 2022, 2021, we are looking at calendar year 2020 and 2021. So still growing, a little slower because now you have to compete with the tough comps, right? How they are looking to land expand is still over 9 years, growing at 40% CAGR, pretty nice. Now, overall, they have 1.28 million customers. But the enterprise and commercial customers, where they have only 191. All others are small businesses, could be individuals as well. But the enterprise and the commercial, they are close to 190,000 customers. But now if you look from a revenue, where's the revenue breakup? Oops, hold on. So there was a revenue breakup of but if you look from a revenue breakup, most of their money is coming from the enterprise and commercial customers. So those 290K customers are contributing to majority of their revenue. At 87% of the revenue is coming from them. So let's look at their financials. Hold on. Okay, let's look at their financials. So looking at their balance sheet, cash and cash equivalent $600 million. Strong cash position, I would say. And most of these cash and cash equivalents or current investments are generally in either cash or treasuries or something that can be quickly converted to cash, right? So almost $1 billion of that in here. Another portion that contribute to asset is account receivables, which is close to $340 million. This is okay, not too big. This is the amount of money that the services that they're provided, but they still have to get the money. If it is too big, then I will have a concern on why are they not getting paid, right? What's happening there? But it's not too big to be concerned about. What else? I see in this balance sheet, I see a goodwill amount because they have done a lot of acquisitions over the last few years throughout their life. They've done what we looked at 4 or 5 acquisitions. Probably there will be more, which are smaller ones. So they do have a goodwill on their balance sheet, but again, not too big. It means they haven't paid too high or haven't paid too much over and above the book value for those companies. Right? So from that perspective, don't see too many things alarming in on the balance sheet. Right? Liabilities side, on the asset side, liabilities side, if you look at, they do have some convertible notes. They took some loans, and which those will, they are 2023 notes, and those will convert into stock if the stock price hits $71.50 on a particular, up to a particular time. And in 2024 notes, it will get converted to stock if it hits $420. I don't think any of this will happen, because given where the stock market is, that seems to be a tough road. Not that seems to be really a steep work ahead of this for them to for the shares to get converted. So essentially, they'll end up paying the loan through their cash, but they have enough balance on their asset sides to basically pay off that loan. Good thing is, it means we'll not have that share dilution as a shareholder. Oh, by the way, yeah, I do own shares in DocuSign. I want to mention that. So as a shareholder, I'll not have the stock dilution because unless the stock price hits $70, the convertible won't move in. Right? So other portion which I see here on the liability side, accounts payable at 44 million. It's okay. Accrued compensation is for 150 million. They have to pay for their employees. Contract liabilities is $1 billion. Right? So, but I believe these are the liabilities which is they don't mention the RPO separately here. So I am assuming that these are the liabilities which they have to, basically they got the money in, but they have to perform, and the how should I, okay, so this will be the liabilities when a customer does an agreement, and let's say they bought, I want 50,000 envelopes for the next 1 year, right? And they pay for that 50,000 envelopes. Now that 50,000 comes and sits here as a contract liability because they haven't started using it. So there's a liability on part of DocuSign that they still have to deliver the services for the customer to use those 50,000 envelopes, right? And as and when customers start to use those envelopes, that liability start to come down. So I'm not concerned that the biggest part of liability is this, because this is, their bookings as and when they get used, this liability will come down and that portion will move into revenue side of the P&L statement. So that's generally how it works. And many of these subscription businesses use this. Is pretty common. We see Roblox. People go and play Roblox. They buy Robux, and I go and buy $100 of Robux, which I need to use in the Roblox games. So that $100 will sit on as a deferred revenue, as a liabilities. Different company use different terms. Deferred revenue, I've seen terms like remaining performance obligations, liabilities, etc., etc. So, but that is goes down as customers start to use that product. P&L side, quarter ending July 31, total revenue was $622 million. Like I said, majority of it is subscription. Small amount is professional services, which is what, if you want to value a company on from valuation perspective, and if you are a product company, the general mix that I've seen is between 15 to 20%. In this case, it is 13%, so even better. Cost of revenue is 130. So gross profit is 485. That is fine. Let's look at the operating expenses. Sales and marketing, little concerning. It means, so essentially, this is how much can you sell? It's just a sales game. More than 65% of its employees are in sales and marketing department. So no wonder that S&M is the biggest expense on their P&L statement. That's like $323 million in a quarter. Net loss, eventually, what's the net loss is $45 million. Not too concerned about it. Company is still in a growth mode. So I don't think they're optimizing themselves for making profit. So I don't even want to focus right now on their profits, right? But these are the times when the companies like these, which are focused on growth and not on profits, markets, pension funds won't like it, because everyone is now looking for, are you making money? Are you cash flow positive? So we'll see if this is cash flow positive or not. But overall, I think fairly okay P&L side. Yeah, the growth has come down, but that's as compared to the heydays and the best days of COVID. Cash flow side, what are we looking on cash flow? So few elements that I want to see in cash flow is stock-based compensation. And what's your operating cash flow is $120 million. So, okay, so overall, let's say 6 months ended, it's $250 million. Yeah, so this is a little concerning to me, that they have to pay the cash, the stock-based compensation has increased as compared to last year. It means you have to pay more stock to either retain or to attract employees. Now, one big reason of this jump could be they got a new CEO. When a new CEO comes in, obviously they make most of the money through stocks. So you have to offer them a few million shares. So So that could be one reason why the stock-based compensation has gone high. Right? But overall, it looks like the operating cash flow is mostly because of the stock-based compensation. Yeah. And this is pretty common among the tech growth companies, right? I've seen worse numbers in this, in which if these two figures, the cash operating cash flow is way lower than the stock-based compensation. That's not, I think it was Palantir. That's not the case in DocuSign. I agree. Stock-based compensation has increased over last year, but I guess that is still manageable. That can be funded through their, from the rest of the operations. Right? Do they have any capital expenses? No, not much. So this is their operating cash flow. Now they have $120 million of what do you call, of free FCF, free cash flow. Right? This is what nowadays market is, and the analysts are asking for. Are you generating cash? So this company, yeah, it is generating cash, but right now most of the cash is sponsored by the stock-based compensation. That's it. So let's look at some of the news. What happened on this company recent times? So the founder and the CEO is a Dan Springer. He was let go and brought in a new CEO, Alan from Google, who was running Google's advertising sales in North and South America, basically whole Americas. I'm excited by this. And Dan was a great founder, bootstrapped the company, established the company as a leading player in e-signature. But e-signature is not where the most of the future growth is going to come from. Future growth is going to come from the cloud side of the business. So, and it is, you need a different kind of a sales and a different kind of a leadership when you're making such a transition on your business model, right? From selling a single product to selling a big story around overall cloud management, right? So not surprising that this company has gone through churn. Both we saw that on the business side also. In some of the previous quarters, the growth wasn't that strong. Not that it wasn't growing, but it was growing at a lesser rate, and then the stock got punished. So pretty common to see that founders, once a company reaches a certain scale, you need a different type of management. CEO that bootstrapped the company, took it to $100 million, $500 million, or $1 billion. Beyond that, if you want to do, you need a different set of leadership. So that's what DocuSign is also doing. Now they're there to expand their opportunity just from signature to overall agreement cloud. They got a new leader, get a new team, train a new team on solution selling, right? So that's where it becomes from a single product selling. Now you have to sell the whole solution. This is a different way in which you approach these two. So I am still hopeful on DocuSign. This is not the stock that I would want to, boast about. Hey, I made it. It's doing great in my portfolio. Obviously not. Now this is hit. This is probably almost the lowest in the last 3 years. It's not only just 52-week low, because this is where like last 3 years. Yeah, it's gone lower than as in last 3 years. But from a business perspective, has its revenue increased? Yeah, and maybe we can let's see if we can find out how its revenue has changed over last 3 years. Even though the stock has got punished, because of Finviz has last 3 years of data. Yes. So total revenue. So this has got yearly data. There we go. Yeah. So look at 3 years. 2019, they made $700 million. 2022, year end 2022, they made $2 billion. So revenue has jumped 3 times, but the stock is even lower than where it was 3 years ago. And there are reasons for it. Maybe someone is predicting, or will they be able to generate enough business and fund their operations through cash? Are they going to come back in the market to raise money? Then they will not get the money how they were able to raise in 2020 at a very very favorable terms because the interest rates were so low. Right? Will they have to do some stock dilution? Will they have to sell some equity? So all those factors may be in. I mean, right now, to me, the balance sheet looks still okay, but the stock is completely different from where the business has been. So I'm still holding it in my portfolio and reducing the cost basis. I think this is where I also have I have a kind of a strangle on this one, so that if it goes down, I am still ready to add it to my portfolio. If it doesn't stays, if it doesn't go down, yeah, I'll reduce some cost basis on DocuSign. Right? The whole story is around Agreement Cloud. Now they do have a competitors. Adobe is one big competitor, but Adobe spent $20 billion in buying Figma. I don't know how much appetite will so they have Adobe has a lot on their plate already. So we'll see. So that's around Figma. Oh, sorry, by Figma. This is around DocuSign. Oops. Yeah, I guess that's it for today. Oh, this is a browser based. Which tab is got Zoom meeting? Where's the chat? Okay, found it. All right. I think that's all I have for today. So you guys still there? I wasn't talking to myself for so long. Hello?
Excuse me. What did you
Okay,
say
all
about
right.
DocuSign and Adobe?
Sorry?
Did you say something concerning DocuSign and Adobe?
Yeah, so I think so Adobe is also into these e-signatures and it's also is a there are smaller competitors, but the big competitor is like Adobe for DocuSign, right? But right now, I think Adobe is a lot more focused on their lunch getting eaten by Figma. So that's they bought $20 billion spent $20 billion to acquire Figma. I mean, the whole acquisition that we reviewed last week. Yeah. So yeah, I won't be happy if Adobe buys this company because I'm generally not in favor of companies acquiring some of these, up and coming startups because then you don't see that a big growth what they can do as an individual companies. But we'll see. But this stock price has been everywhere, right? In last 3 years, from the highs of $314, and I guess maybe that's where in 2021 probably that's where they got those funding, those raised money in the markets, right? Thank God, and at very favorable terms, and with a $420 as a convertible stock price, as a strike price for their convertible bonds. All right, I guess I'm tapped out for today. Any last minute questions before we call it done? Cool. All good. All right. Well, let's finish right here. So thank you everyone for joining in today. Sorry, I'm not on the top of the game this week. Didn't have too much time uh, for for my passion, for my hobby. The main job was too hectic this week, but yeah, I mean it's good. Given what's happening on the technology side of the markets, if you are over occupied, I guess that's a good sign, right? Job security. So cool. Then we'll talk again next week, and let's see what markets bring. Let's see if October brings us some better hopes. And you know, with September gone, maybe the worst is behind us. Statistically, the worst month is gone. Will we see Santa rally? I have no idea. Anyone has no idea. Statistically, Q4 is good, but history doesn't always repeat. It does rhyme, but it doesn't repeat. So stay hedged, stay invested, don't freak out, make sure your position size is good, and we'll come through this. We'll get through this. This is not the first time. This won't be the last time. Thank you, everyone. Goodbye. And we'll talk next week.